Okay, can you hear me?
I can hear you, Jack.
Okay, I hear you fine.
All right, Jack. First of all, I want to thank you so much for taking the time out of your day to address the F.A.C.E community. I also want to thank you for sending me a copy of the book. If you can see the screen, I'm showing it here. A Complete Guide to the Futures Market, 2nd edition. And we're going to spend the first part of the interview talking about this. Let me share my screen. There we go.
Yes, we can see it.
Okay, there's your book, Jack. It is one of the most comprehensive books on the markets that I've ever seen. You know, I've joked to people that you could come up with any question about the futures market and you'll find the answer to it in here. Congratulations on a great work.
Oh, thanks a lot, Dale. Appreciate it.
And you know what, Jack? I think this should be required reading for, first of all, anyone that wants to trade futures. And second of all, more importantly, for anyone who wants to get a license to be a Series 3 broker or a CTA. If you want, I'll send a letter to the NFA and CFTC and suggest it. But it's so comprehensive that it's not a quick read for anybody, unless you took Evelyn Wood. But it has everything in it that anyone that's going to trade these markets would not know and can learn. So I just want to pick up on a few points from your book. And then the second half of the interview, I want to talk about FundSeeder. Okay, buddy?
Hey, sounds great. Sure.
Okay. So there's always a big debate, and you addressed it in the book, about fundamental analysis and technical analysis. And my training was, you know, technical analysis of stock trends by Edwards and McGee. That was the Bible in the 70s. So I was always a chartist, and to me, patterns and everything like that meant everything. And then I would go and look at fundamentals to see if it backed up what I was seeing technically. And you talk about one of the biggest mistakes that people could make relying on fundamental analysis is using the wrong sources for their fundamental analysis. For example, blogs and you know, people that aren't credible sources, and that you should use government agencies like the CFTC reports or the Department of Agriculture report. Have you noticed in your training of people that people gravitate more towards fundamentals or technicals, and which way do you gravitate?
Okay, well, I think that's a personal issue in the sense that I think for some people, fundamentals are the right approach, for some people, technical are the right approach, and for some people, combination is the right approach. And there is no answer what's right for everybody. It's really something that you have to discover on your own. You know, myself, I started out as a fundamentalist, you know, went to technical, went to computerized trading, and then ended up discretionary technical. So it's really a self-discovery in a way. And however, having said that, and while I've known people who've disdained technicals and just used fundamentals and did great, and vice versa, but the big thing that I find to be advantageous about technical versus fundamental is that technical, the risk management is sort of natural with the approach, whereas in fundamental, it's almost in opposition. By that I mean, if you decide something is underpriced, let's say you decide that wheat is too low when it's $6, and you buy it at $6, and then it goes to $5.50, and nothing has changed. Well, it's even a better buy, so you should buy more. So that makes the combined fundamentals and risk control is tough. So that's one reason, one advantage.
I think a quote out of your book is one of the biggest mistakes is to be rigid on a fundamental view. But wouldn't that also apply to being rigid on a technical view? You could always find something technically to justify your position.
Yeah, but the thing is, with technical, it will likely change. So, you know, if I'm if I'm rigid, if I say, well, this is, this market's going to, an uptrend and it's going much higher, and I'm very rigid on that, but if it starts breaking down, if I'm true to my approach, eventually I got to admit, well, it's not an uptrend anymore, right? But in fundamentals, It's just the opposite. If I'm rigid that something is too cheap and it goes down and nothing has changed, then I think it's even cheaper, so that's the tough part, that's where the tough part comes in. And in fact, ironically, one of the things I do point out in the book is that one of the best uses of fundamentals is not in the conventional sense, but it's almost in a contrarian sense. In other words, some news comes out that should be really supportive to your case. Let's say you're bullish and you expect the market should go up, and instead it barely reacts. Well, that might be a bearish signal, So in that sense,
so it's already priced in, and that's most technicians believe that markets already are pricing in fundamental events to the most part, and that's how you have, like, on a good earnings report, the stock has gone up and up and up, and then they get good earnings, and it's buy the rumor, sell the fact.
Yeah, and I find there's no consistency in that. Sometimes they are, sometimes they aren't, sometimes it isn't. But how a market reacts to news, on balance, is useful. So even if you're a pure technician, seeing how a market reacts to news can be helpful. And there's all sorts of I can remember, let's say, I think there's millions of examples, but I remember it was like Kurt late at night at F.A.C.E. When the nuclear reactor in Japan, you had the tsunami, right?
Oh, the Fukushima.
That news hit, and I remember that the currency getting hit, and then but then 20 minutes later it turned around completely and it kept going. So stuff like that is very interesting.
Yeah, that's kind of like the saying, people who buy headlines today sell newspapers tomorrow. I think that one of your key lines in here, and I teach this, and I think everyone should write it down. You say, and I quote you, know when you're going to get out before you get in. And I assume that's talking about risk management, but it may also apply to targets and objectives so that you have a complete strategy before you commit to assuming risk on a trade.
Yeah, it's actually a quote from Bruce Covener, and there's a material in this book that really summarizes some of the key lessons from the Market Wizards books. There's a whole chapters on that. But then that particular quote, yes, it was mainly intended for the risk management portion of it. However, incorporating, as you said, a full plan as well as where you get out is certainly beneficial. The thing that makes it particularly important on the risk side is simply that loss of objectivity once you're in the position. And it's one thing to let a loss get out of hand, but if you're not perfect in taking a profit, well, that's not as bad as getting killed on a trade.
Yeah, so isn't that, say for example, when you take a trade, maybe you'll have a confluence of things coming together. It could be some type of trigger, whether it's MACD, and you have some moving averages coming in there. You have some major support, resistance pivots. So your reason that is compelling you to take the trade, and then once those contingencies are negated, that's your reason to be out of the trade.
Well, yeah, if it's based on in that case, it's based on fundamental reasons, and if those fundamental reasons no longer apply.
Yeah, those are technical reasons. I wouldn't know how to manage risk with a fundamental opinion.
Well, the technical reason, if they're technicals, that only imply a short-term move. But I guess from my perspective, a lot of times I think technical is more as short-term signals with long-term implications.
Okay. I also remember from a prior interview, I asked one of the most important things that a trader could do, and you said that each trader should find a style that fits his personality. I want to move to, trade your plan the trade, trade your plan, and you spend some time in the book talking about having a planning time routine. Is that something that people do every day? I mean, a lot of my planning is done on the weekend when the markets are closed and there's no noise. What do you recommend for traders?
Yeah, and no, it doesn't have to be, that depends on your style. So,
Okay.
Some people do it like every evening. Some people do, at the end of the week. It depends on their style. And there's a lot to be, if you're longer term, at the end of the week can often be very good because it keeps that long-term perspective as long as the risk management is there, to cover you during the week. But any of those, whichever one is right for the time frame you're operating in or your particular approach, either one of those is fine. The point is, it's not a shoot from the hip approach. It is something that is planned out. The worst trades I find are the trades if you're in front of your computer and you see the market do something and you weren't planning anything. You say, well, that looks. Let me buy that. Or let me sell that. Those are usually the trades that don't work.
Yeah, that's impulse trading. So you're seriously against impulse trading or FOMO trading.
You know why? I mean, there's a good reason for that because and I've pointed this out in other books and this book as well probably. But our natural instincts are just not good for trading. The things we do naturally as humans, the emotions we have, and this goes into behavioral economics, are just very poorly attuned to making correct trading decisions. So the odds are, if it's an impulsive trade, that it's just you're reacting to a human emotion, and it's usually not going to end well as far as the trade goes, which is different, though, than if you're seriously following a market and you see something happen. You've got an intuition that the market is a strong intuition that the market's going in a direction. That's a bit different because there the intuition is really coming from your experience, and that's not the same as an impulse. So how
long does it take in your experience, and you've interviewed wizards? I've talked about, people having unrealistic expectations about how long it would take for them to maybe make breakthroughs and start to become not just break-even traders, but profitable traders. And I use the metaphor like you go to college for an undergrad degree for 4 years, and even if you're in a trade, you're an apprentice for many years. And Blake brought up that some of the traders that he works with on a fund, their assistants just sit by the pro for 5 years before they could do anything. In your experience of interviewing trades and even personally, isn't it realistic to expect the process to take not months but several years before because you can't learn experience?
Yeah, absolutely.
It only comes with the passing of time.
Yeah, absolutely. Real time is slow in that sense. You just can't get, as you say, you can't get experience in 3 months. So so traders, new traders come into this with very unrealistic expectations. And
would you say it's like going to college, at least for an undergrad degree?
That's a fair, time-wise, that's a fair analogy.
Okay. I also wanted to ask you, you brought up keeping a trading diary and a spreadsheet. And perhaps you could explain, I know some people are just too lazy to do it, and then I've talked to some successful traders that used to do it, and I got an answer. I asked if they still kept a diary, and they said that they were too successful and too lazy to keep doing it.
Well, I guess...
Go ahead.
If you're too successful, then there's no problem. But the idea behind that is that we all make mistakes. Everyone does, and not only you make mistakes, but you repeat mistakes. Now, the great thing about if you write them down, and it doesn't mean that you have to you have to make a diary for every trade. I mean, you keep a record of every trade, the reasons why you did it, and how it worked out, and you can build up a database like that. You may be able to distinguish, which types of trades are working, which ones are not. So it's kind of useful from that type of analysis. But one of the key things about it is if you write down trades that are really where you made the decision that there's some insight there or some lesson to be learned, and particularly if it didn't work out. So like if you made a mistake and you know what the mistake was and you write it down and you say, never to make this mistake again. But if you're reading that with some regularity, maybe it won't keep you from ever making that mistake again, but it will certainly reduce it. So instead of making the same mistake 20 times, you'll make it twice or whatever.
So it helps you by writing things down, create a new paradigm for yourself. I think psychologists, NLP people call it neuro-linguistic programming, and a diary would be a big part of that.
Yeah, it reinforces the right things to do and the wrong things to avoid from your own experience and by your own methodology, and that's very helpful because there's something. I mean, you're going to lose a certain number of trades even if you do everything right. That's part of it. It's a probability game, right? But there are trades where you lose not because of probabilities, but because you didn't do what you knew you should have done. Or, you know, and that happens all the time. So if you can reduce those mistakes, then it can't but help but improve the results.
Okay, I have one more question before I shift gears to FundSeeder, and it really applies to people that are not discretionary traders, but they believe in systems. You know, when I was a little bit more jaded or naive or egotistical, I used to say system traders are for people who don't know how to trade, but I've since changed my mind that, you know, automatic pilot can be great. And you talk about back testing. Can you just lay out a couple of the errors that people make when they're back testing and the best way to go about it when they're back testing their system?
Sure, that's a great question. I'm glad you brought that up for people in your audience who do systematic trading. The biggest mistake people make, and it's a giant mistake, and it really leads people wrong on this, is they use hindsight, and they draw conclusions which are hindsight contaminated. I think that's a good word for that.
I like that.
And so the important thing is and I talk about there's chapters, and there's multiple chapters in the book that talk about this, but the important thing is to use a testing methodology that avoids hindsight. And there are ways to do it, and like I say, we don't have enough time to go into that now, but there are ways to do it, and they're explained in the book. So I think it's critical to avoid hindsight. And the other big mistake, and I got to throw this out because this is another giant mistake people make, is a blind reliance on optimization. The reality is, people will create a system that fits past really well and find the best variation, and then believe that's a good representation of what the future is going to be. The reality is, and people will discover this if they do this work, that there's very, very little benefit to optimization. And what it ends up doing more is fooling people as to what the system can do. So I am one that avoids creating systems that are overly optimized. I think that's a big mistake.
Okay, so optimization equals unrealistic expectations of your system.
Right, and often systems that are not robust. They're fit to the past, but they won't work in the future. And again, so those are the two big things. Those are the two big messages I would leave people who are interested in systematic trading that they need to keep in mind.
Okay, Jack, I'm on your FundSeeder website now.
Yep.
And I could tell you this, I've been involved in facilitating and moderating trading rooms for quite a few years with both prop traders, retail traders, running communities of people trying to learn to trade. But I'll tell you that over the years, I know many, 30, 40, 50 traders that always, would share their work and their trades, and it's not a hobby for them. This is how they support their family, put a roof over their head, food on the table, have the lifestyle as a trader. So why don't you explain to that crowd of people that are already proven that would have P&Ls to document their performance, what FundSeeder is and how it might be a fit for them?
Sure, thanks. Well, the concept behind FundSeeder is to create a global meeting place or a connector between trading talent and allocators looking for new traders or undiscovered trading talent to allocate money. As the business is now configured, the vast majority, probably close to 90% of the money goes to a relatively small number of large managers, but globally there's millions of traders out there, and tens of millions probably, and out of that, there's many thousands and tens of thousands of good traders who never have a chance to get anywhere because they don't have the right connections or they don't have the right people, they're in the wrong country, whatever. So the idea was of FundSeeder was to set up a website where traders globally could link their accounts and daily have their accounts verified, and we have all sorts of analytics on that site, which you can't see the analytics unless you actually register, unless you actually link up an account. But then you basically can do stuff like chart your equity curve. You can even do technical analysis on your equity curve. You can generate all sorts of statistics. You can do underwater charts. There's a whole platform of tools that are available and continually expanding, and we provide that all for free because not because we're saints or anything, but we do that because we want to get a larger critical mass of traders. We want to become the site that traders worldwide go to for free analysis of their trading, but also have an opportunity to establish verified track records. And so we provide that, and then we have a sister company that does that looks for that does the investment side.
Okay, so the sister company, FundSeeder's been online, what, a couple years now, Jack?
Well, FundSeeder Technologies has been a few years, and we've totally focused on developing, and we're still, in fact, we're now got some partnerships coming up. We're going to be expanding that platform tremendously over the next year probably, but we're focused on the trader product. This year we're going to begin developing the investor side of it, so for the sister company, and that will use the database of the trader side. So
how many traders have you discovered through FundSeeder that have been actually reached the level to where they've been funded in the last few years?
Well, like I say, we focus on just on the technology side. So the investor side, we've placed some traders preliminarily, but we haven't really, we had to do this in steps because we started out as a largely self-funded tech startup. And we're only now beginning to establish some major partnerships. And so the plan was get the trader side first, then do the investment side. But once you have a critical base, and so now we're developing that, and that side is just preliminary. It's not developed like the trader side. That side, in fact, we've got our technology team is actually in Ukraine. And I'm actually traveling out there this month to work with them on developing the trader side, the investor side.
Interesting. So can you explain what would be the difference between what you're doing and a lot of prop trading firms? Because a lot of prop trading firms, it's not exactly a level playing field for the traders that come in. I mean, part of their models and profit center is they're happy if someone just moves sideways because they have an IB deal or a BD deal where there is a profit center based on the volume of traders, the volume of trades from their traders, and they have to pay a lot of money to get into the program. Are you familiar with what the prop world is like out there, and how is FundSeeder different?
Yeah, it's a little bit, and our model is different. You can think of us more as the web version of a third-party marketing, in the sense that our model is not to make money on commissions or as some firms have a trader following other traders or anything like that. Our model is, have the one site find traders and have the other side use that database to place those traders with investors who are interested in finding trading talent, and make that a modern web-based function rather than a manual function. So we see this as sort of bringing the connecting of the traders and investors to the modern age, to globalize it and to democratize it basically as well.
Okay, I'd like to wrap it with this question, Jack, that I've been asked for decades. People said, Dale, what's the correct amount of equity that I can trade with so I could trade for a living? Or they'd say something like, can I trade for a living with a $10,000 account? And I would answer them, yes, if you want to live beneath an underpass. So I'm sure that you're asked this question, and in FundSeeder, I see that you're educating newer traders. What do you tell them? It's probably not a dollar amount, but you know, people have to be able to live through drawdowns and still support themselves.
Yeah.
And, you know, all the smart guys have more than one income stream than just their trading account, don't they?
Well, I mean, I know traders who just live obviously just as traders, but it's hard. I mean, the people, you know, earning a living as a trader is hard, and you can't just do it coming out without having a lot of money, because you need enough money that you can afford to lose, and the base has to be enough so that a realistic percentage gain during the year is enough to live on. And those are not easy things to fulfill. So realistically, for many people, it would mean actually building up some wealth in other ways, so they have the money that they can trade, or if they can, you know, managing money and earning fees off of that, and maybe you're trading their own money then as well. But I mean, look, if you could do 20% a year consistently, you'd be a star. Well, you know, how much do you need to live on? And then and you can't risk all your capital. So if you just do the simple arithmetic,
so
yeah.
You answered my next question. You know, I've said to people that fund managers do cartwheels doing 25% a year on their equity. And
the best traders
would consider a real, yeah.
Yeah,
And
I think
the
somebody
best
like
traders in the world are happy with that, aren't they?
Yeah, well, I think somebody like Stanley Druckenmiller is one example, who's one of the best traders of all, you know, one of the best traders that is, you know, of modern times. And so he ran his own fund for almost 40 years, came close, you know, had an average return in the high 20s, and he's considered one of the best that ever lived.
Right.
So, you know, yeah, so you have people starting out in this business say, oh, I want to make 300% a year. Well, hello.
Yeah.
You know, there's something called reality here. You know,
unrealistic hype on the internet, and you talk about that in your book too. I want to wish you all the success with your new book, Jack, the second edition, A Complete Guide to the Futures Market. I also encourage people, if they're an aspiring wizard, could I say that people that go to FundSeeder and use your technology to monitor their account, that they have the potential to be a wizard someday, that you know, your book was about a previous generation of wizards, and there's always going to be a new generation of wizards. So thanks so much for being with us today, Jack. It's always a pleasure to talk to you, because you've talked to the best, and really an excellent book, and really should be required reading for anyone getting ready to trade or become a Series 3 or CTA broker, in my humble opinion.
Well, I appreciate that, and I appreciate your taking the time to really go through everything and for the insightful questions.
Okay, Jack, we'll pick it up again and sell 1 million books. And thank you so much for starting FundSeeder for people that, you know, didn't go to Harvard, you're not connected to Goldman Sachs, and have trading talent, for them to have a route to become a successful trader. Thank you for that good work.
Hey, thanks a lot.
All right, Jack. All right, everyone, that's Jack Schwager. Pick up his book. I hope everyone enjoyed that interview. And we'll talk to everyone tomorrow. I have another great guest tomorrow. I'm not going to tell you who it is. You'll have to show up. You're very welcome. You're very welcome, Doug. Adios, my trading warrior brothers and sisters. And remember, don't just count your pips. Count your blessings. You're welcome, Brooke. See you, Greg. You're very welcome. See you, Hasselhoff. You're welcome, Nuno. Bye-bye. See you, Luca. Kevin. Everybody.